I've been tracking almost every weekly paying ETFs in Roundhill and Yieldmax closely, and honestly, the results have been crazy, but not for the reasons you'd think. Some of them are doing great, others not so much. And the reasons why might surprise you. See, a lot of people look at these ETFs just for the big weekly payouts. They think, oh wow, I'm getting paid every week, and this must be amazing. But what most people don't realize is that the yield alone doesn't tell the whole story. The real question is, how much are you actually making overall after price changes and payouts combined? So, in this video, we're not just ranking ETFs by who pays the most. We're looking deeper. Which ones are truly performing, which ones are just hyped, and what's really driving those returns. By the end, you'll have a clear picture of what's actually working and what might not be worth your money. Before we get into the actual ETFs, here's a quick disclaimer. Everything in this video is purely for information and education. I'm just sharing what I've learned and how I look at things. Always contact a professional to make personalized decisions. Let's first clear up why we're focusing on just two names, Roundhill and Yieldmax. Because these two represent completely different ways of thinking about income. Here's the simple breakdown. Roundhill is all about bullish aggression. They take around 120% leveraged exposure, which means when the market goes up, they go up even more. And they still pay you weekly by selling calls. But they're doing that on top of the leverage. So you get both growth and income potential. Yieldmax, on the other hand, is focused mainly on income stability. They use synthetic covered calls, meaning they're creating that call selling strategy with options instead of holding the stock directly. The trade-off is your upside is capped. You'll get higher consistent yields, but not much participation if the stock takes off. Now, personally, I lean toward Roundhill in 2025. Why? Because we're in a bull market environment. When markets are trending up, leverage becomes your best friend. It amplifies those gains, and you don't want to be capped when the momentum is strong. But Yieldmax absolutely has its place. If you're being conservative, or if you prefer stable income over growth, it can make sense, especially with ETFs like LFGY, which give you diversified exposure instead of tying everything to one stock. It's a smoother ride, even if you're not getting those big upside pops. Here's what really separates them. With Roundhill, you benefit directly if the stock rips higher. A great example is HOOW. It gained about 79%. Showing how much you can capture when the underlying stock moves. With Yieldmax, since your upside is capped, you won't fully ride a big move, but your NAV tends to stay more stable because that cap gives some cushion. Alright, now let's get into the rankings. My top 7 weekly paying ETFs from Roundhill and Yieldmax. And remember, I'm ranking these based on total return, not just who's paying the biggest yield. Because at the end of the day, you care about what's actually growing your money, not just who sends you the fattest check each week. Coming in at number 7, we've got SMCY, the Yieldmax Super Microcomputer ETF. Now, this one's pretty new to the weekly club. It recently switched from monthly payouts to weekly, which already makes it more attractive for income-focused investors. Over the last 6 months, SMCY is up roughly 51%, which is pretty strong, especially when you consider how wild Supermicro's stock has been. Remember, this company is at the heart of the AI infrastructure boom. They build the servers and data center hardware that power NVIDIA. So if you've been wanting AI exposure but don't want to chase NVIDIA's already crowded trade, this one's interesting. But, and this is a big but, Supermicro had some accounting issues in 2024, which adds a layer of risk. Even though the company has bounced back, it's not as squeaky clean as some of the other AI names. So, while the returns are great, I'd treat this as a high-risk, high-reward play. Here's a positioning tip for this. If you're adding it to your portfolio, keep it small. Personally, I wouldn't go over 3% of your total portfolio. Think of this more like a spice, not the main dish. At number 6, we've got NVDW, Roundhill's NVIDIA Weekly ETF. Since launching in mid-2024, it's up about 36%, which is solid considering it's been only a few months. So, why not just hold NVIDIA stock instead? Because NVDW gives you amplified exposure, about 120% of NVIDIA's daily movement, meaning it tends to rise or fall a bit more than the stock itself. On top of that, it pays weekly income through its covered call strategy. So, you're basically combining growth potential and consistent cash flow, the best of both worlds. If we compare the performance of this ETF with NVIDIA itself, if you look at the same time period, it was up around 30%. So yes, that little bit of leverage did add extra value here. personal take. I'd call this a core AI momentum play. But keep in mind, NVIDIA's valuation is stretched. It's still a great company, but a lot of future growth is already priced in. So for me, NVDW is more of a ride-the-trend play, not a buy-and-forget holding. Next up, number 5, LFGY from Yieldmax. This one's really smartly built. It's about a 70-30 split between big tech and crypto, mainly Microsoft on one side, and then names like MicroStrategy, Coinbase, and Bitcoin miners on the other. Year to date, it's up around 19%, and the cool part is, it's doing that with less volatility than most crypto-related ETFs. That's because Microsoft acts like an anchor. It keeps things stable while the crypto names bring in the upside. So if you've been wanting crypto exposure but can't handle those insane swings from something like COINW, this is a solid middle ground. You get the flavor of crypto, but without the heartburn. Now for number 4, COINW, Roundhill's Coinbase Weekly ETF. This one's a perfect example of why Roundhill's model can outperform. Over the same period, COINW is up about 26%, while Yieldmax's version, Connie, actually fell by around 1.5%. Why the difference? 2 main reasons. First, crypto regulation got a lot clearer recently, which helped Coinbase. Second, Coinbase isn't just an exchange anymore. It's expanding into staking, derivatives, and other new services. That diversification makes a big difference. If we compare both, when Coinbase stock moves about 10%, COINW tends to move around 12%, thanks to that built-in leverage. And don't forget, you're also collecting weekly income while that's happening. But we can't ignore the risks, cause, let's be real, this is still a crypto volatility play. The swings can be huge, both ways. So, size this carefully. Again, something like 3% to 4% is plenty. You don't want to go heavy here unless you really understand the risk. So, that's 7 through 4. A mix of AI, crypto, and hybrid strategies that give you both excitement and income. But the top 3? These are the ones I think actually get the balance right. Strong performance, weekly payouts, and strategies that fit this bull market perfectly. Number 3 is PLTW, the Roundhill Palantir Weekly ETF. And wow, what a run. It's up about 65% total return, making it one of the best performers on this entire list. Here's what makes Palantir different. Unlike most AI names that rely on consumer products or cloud growth, Palantir's got a revenue floor from government contracts. Those deals are long-term, stable, and not going anywhere. Then on top of that, you've got its, which is still growing fast. That's your upside, your growth ceiling. So you're getting both safety and excitement, defense spending and artificial intelligence in one name. And that combo, in my opinion, is a long-term secular trend. That's why I really believe in this. Now, the risk, valuation. Palantir's price-to-sales ratio is pretty high compared to most software names, meaning investors are paying a premium for that growth story. But momentum is still strong, and Roundhill's leverage setup helps capture that upside. For me, this is a core position. I keep around 8 to 10% of my weekly ETF allocation in PLTW. It's one of those ETFs that I don't plan to flip quickly. I'm holding through the AI cycle. WPAY, Roundhill Weekly Pay Universe ETF. This one's really clever. It's a fund of funds that holds all of Roundhill's single stock weekly pay ETFs in equal weight in one ticker. Launched on September 4th, 2025, it pays distributions weekly. If I talk about why I love this, it's simply because if you want simplicity and broad exposure, WPAY gives you a way to access a diversified basket of weekly pay, leveraged single stock ETFs without having to pick one. Portfolio roll. I view this as your one-and-done weekly ETF position for someone who doesn't want to choose NVDW or PLTW or another single name. Trade-off. Because it's spreading the risk across many names, you might miss the highest performer that a single stock ETF captures, but you also avoid some of the risk of picking wrong. My suggested allocation is, if you're looking for a balanced weekly ETF portfolio, I'd suggest putting about 30 to 50% into WPAY if you want broad access with less hassle. And finally, number 1, HOOW, Roundhill's Robinhood Weekly ETF. This one has been absolutely insane, up about 79% since August 2024. It's the clear standout. And no, it's not just a meme stock story anymore. Robinhood's business has matured. They've got diversified revenue streams, trading, gold subscriptions, crypto, and even interest income from idle cash. Here's the cool part. Whenever retail investors start trading more, Robinhood's numbers shoot up. And that's exactly what's happening right now. The market's hot, people are active again, and that's the perfect setup for Robinhood to make more money. I'll be real with you. This has been my best performer, hands down. But when something's up nearly 80%, you can't just sit back and hope it keeps running forever. You've got to manage your risk. So here's what I did. I took profits gradually. When it was up around 60%, I sold about 25% of my position, just to lock in some gains. And I'm letting the rest ride with a trailing stop. That way, if it keeps climbing, I still participate. But if it drops hard, I'm protected. Here are some important things I've learned about managing these. First, let's get into some performance patterns I've noticed. 1. The leverage advantage is real in trending markets. When stocks move consistently higher, Roundhill's leveraged weekly pay ETFs tend to crush the capped Yieldmax ones. That 120% exposure really compounds when the market doesn't whipsaw. 2. Weekly income compounds faster than you think. 52 distributions a year versus 12 might not sound like a big deal, but the reinvestment adds up fast. Think about it. Getting paid every week gives you more compounding intervals, even if the amount is small. 3. NAV matters way more than yield. I learned this the hard way with Ulti. The yields looked incredible, but the NAV wasn't growing, and in some weeks it actually dropped faster than the payouts could cover. Total return is what counts. Distribution yield plus NAV change. That's the real performance. Would you rather have a 50% yield but lose 30% of your capital, or earn a 30% yield while your ETF grows 40% in value? That's why I don't like Ulti. Those distributions only looks great on paper, but the total value isn't moving up. The leverage double-edged sword. The wins feel amazing. A 30% stock rally becomes 36% with leverage. But we have to remember about the downside too. That same leverage cuts both ways. A 20% stock drop turns into a 24% loss. When NVDA fell 15% in March, NVDW dropped about 18%. So when I say I never put more than 10% in a single leveraged ETF, because I'm not trying to lose my investments. These are the conclusions I came to after looking at these ETFs for months. If you want to know the perfect retirement portfolio, make sure to watch this video as well. I break down everything step by step.